Today's Animal Spirits is brought to you by our friends at yCharts. yCharts has this cool new feature. If you're watching on YouTube, you can take a look at the chart. If not, we have a link for it. And you can now break out different segments of revenue by product. So, for example, we have one of iPhone revenue by Apple. And on the top pane, we show the iPhone revenue. On the bottom pane, we show the market cap of McDonald's, Accenture, Pfizer, Netflix, Intel, Wells Fargo, and Walt Disney. And the revenue for the iPhone is bigger than all those companies.
Holy
market
moly.
cap. Which is just pretty nuts when you think about it.
The iPhone has more revenue than, I mean, you said it, McDonald's.
The McDonald's market cap. It's pretty cool. So
you can make these. You know the phrase "stop and think about it"? I mean, Barry says it a lot. In this case, I actually would like to pause and think about it.
Are you ready to cover your paper short on Apple?
No.
No. Okay. You're pressing the gas. Okay. All right. If you want to learn more to make charts,
first of all, I'm not short. I'm not outright short on paper. I sold paper calls.
Okay. You're not a buyer. You're not a seller. If you want to make more charts like this, check out this new feature. Go to yCharts. Tell them Animal Spirits sent you. Get 20% off that initial subscription.
Welcome to Animal Spirits with Michael and Ben. You know, one of the great things about social media, sounds trivial and childish, but it's true, are the memes. There was one going around over the weekend of Kevin James. He's sort of doing what do you call this look? Like a smirk?
Just a little smirk and a shrug.
And it got captured into oblivion. And one that I saw that made me literally LOL comes from Josh Black. Me after hitting no tip and turning the tablet back around.
Not bad. It is like the power of the internet, how something like this can just, I don't know how it builds. Also, what was the show called? Not Kevin Can Wait. It was King of Queens.
Yeah.
I liked that show.
Great
back
show.
In the day.
I never watched it, but great show.
I mean, the Costanza's dad from Seinfeld. I guess you never watched that either. He was played the same character basically.
Upon reflection, by the way, there's an Office reboot.
Yeah, I'm not thrilled with that. I mean, The Office was the last 3 or 4 seasons were going downhill already. So the fact that they're doing another one is not a great sign. Upon
self-reflection, I'm not quite sure why, but I missed like all the great sitcoms in the 90s except for I watched Friends.
You know, maybe it's because you were too busy doing whatever in college, but we would get home from class and watch all the reruns on TBS every single night. Seinfeld reruns would be on, Friends reruns would be on. That's when you'd watch them and catch up and watch all the episodes.
Yeah, I guess
too busy taking part in extracurriculars. I can't say that word.
Yeah, and watching. I guess I was more of like a movies and sports guy, not really a sitcom guy. But I was thinking about Twitter, and I know it's not in vogue to say positive things about the Bird app. I love the For You column.
Really?
Is that a zag? I love it.
That's a big. You're the only one, I think, because no one else does.
So I had complained, one of my gripes about Twitter over the years, not really a gripe, more of an observation about how lousy the business is, was that I spend, I don't know, 6 hours a day on the damn thing, and it's serving me up, women's deodorant ads, just has no idea who I am. And finally, Twitter gets me.
On the For You.
The For You tab is just chock full of nuts.
So I checked out Threads for the first time in about a month last week. We can't post there anymore because of compliance reasons. I guess it's our compliance thing that stores these social media accounts doesn't do Threads yet for some reason. So we can't post there anymore. We tried. But I looked there, and it was basically everyone I follow on Twitter just copy and pasting their tweets from Twitter to Threads. So I'm sure there are people posting there who aren't on Twitter anymore, but I don't see the need to check 2 social media apps during the day. Yeah. It seems like a lot of work.
How's your office?
All good. No construction this week. There's nothing going on. Hopefully, there's still all the walls are barren outside, but I'm still hanging on here.
You know, last week when I mentioned how nothing on the internet works as advertised, all like these hacks, somebody sent us a video about the right way to eat an apple. The guy says he eats 3 apples a day to the core.
Really? I mean, what's the right way to eat an apple?
Yeah, I didn't watch the video, but from what I gathered, this person eats the apple all the way through, and the only thing left when he's done is the stem.
Okay.
Is that how the cavemen did it? Is that where the nutrients are?
My kids make me peel the apples for them every time they eat one, which is kind of a pain in the butt. Like 3 apple peelers in my house.
I love peel. I'm not a skin guy. One last thing before we get into the show. Speaking of nutrition, I drink athletic greens because, believe it or not, advertising works, and I feel good about it. There's a lot of minerals and things that I don't otherwise get. Doesn't taste great.
I mean, it doesn't sound good to me.
Doesn't taste
Just
great, but you know,
name alone.
but you know what? Something that tastes like that, you just know it's rich in a good way for your body. My body's the temple, Ben.
I can tell, but based on your athletic gear, I gotta take. I've been preheating the oven for a while now. Okay, gold me on this one. Before you, just let me lay out my case before you push back, because I think you're gonna push back. We already had a soft landing.
Oh, come on. I'm just kidding.
No.
Go ahead. I'm just
Okay.
kidding.
So I looked back. The first time I wrote about a recession, it's kind of hard to believe, but it's been more than 18 months since the Russia invaded Ukraine, and commodity prices spiked, and inflation went above 5%. And I wrote a piece in March of 2022 saying every time inflation has spiked above 5%, the only way we've brought it down is through a recession. We talked about all this at the time. It's been 16 months since we had $5 gas, $120 oil, and 9% inflation. Since then, the unemployment rate has actually fallen, inflation fell, wage growth rose, then fell, GDP growth accelerated. What if we already had the soft landing? It's been a year and a half. I mean, that's a long time to be debating this. Is that not kind of a soft landing already? Didn't we already have it? How long does it have to last before we declare, okay, we had a soft landing? I think we
So
kind of did.
are you saying that I'm trying to squeeze a transitory joke out of this, but I'm coming up short.
So I think cycles are faster anyway. I think a year and a half of low unemployment, inflation falling, GDP growth accelerating, that sounds like a soft landing to me.
I guess
Call
where
me
I'm going
crazy.
with this is the opposite of the transitory talk. It's like, 14 months into inflation remaining, you can't really say it's transitory anymore. I guess this is the opposite, where it's like we're not ready to declare a soft landing. We haven't landed. I guess what I would say is the Fed is not. The market seems to think that they're probably done, but they haven't said it. They haven't necessarily said that they're done yet. And it does seem to me that there are more risks to the economy than there have been in a while, between all of the strikes, between oil prices rising, between interest rates reaccelerating, between the dollar reaccelerating.
But you can't tell me that the risks are higher now than they were 18 months ago. 18 months ago, the risks were way higher.
Oh, that's a fact. That's a good point.
That's just kind of funny, and maybe it doesn't matter, but the Fed seems to think higher for longer is the new thing. So even on based on their projections, which their projections, I don't know, roll them up in a ball and throw them in a trash can because they're
Agreed.
worthless. But they say 2024 their Fed funds rate is going to be 5.1%, and by 2025 it's 3.9%. The thing is, I see people making two arguments. The rates are going to remain higher for longer, and we're going into recession. I'm sorry, but doesn't two solve one? You can't have both. I don't think
Yes, you can.
Every recession we've ever had, rates have fallen. Go look.
What if rates stay high for the next? No, that's true. I think once we do get a recession, the rates part will take care of itself. But what if rates stay high for another, I don't know, year or so, and then we get a recession? Can't that happen?
Yeah, but isn't that a soft landing though? 2.5 years of, I don't know. So Cam Harvey, who is famous for making the yield curve, he was on Compound and Friends before. He said the Fed is making a mistake. He kind of has a Jeremy Siegel, Jeremy Schwartz thing where he said if you look at shelter inflation was normalized, core inflation right now is 1.5 to 2%, below the Fed's target. He basically is saying the Fed is waiting. They're going way too long. And he said the higher the rates go, the worse the recession is going to be. Here's my question. So let's say the Fed did want to declare victory in a way, and they said, you know what? We're not going back to ZERP, but we're going to slowly lower rates to 4% over the next year. We want to get to 4%. Would 4% really be the end of the world? I know stocks would probably take off and bonds would rally, but 4% is not like in that scenario, you're not going to get a bunch of refinancing from people because they all already have 3% mortgages. It gives people a little bit of breathing room in terms of no more 9% car loans and no more 7% mortgage rates. It just makes them a little easier to stomach, and it makes it easier for corporations to borrow. How bad would 4% really be if the Fed said that we're going to declare victory, we're going to go back to 4%? Would that really risk taking away everything that they've done?
Could.
I don't know. How?
They're still worried. I mean, inflation is still here.
I just think if the Fed wanted to avoid a recession, they probably still have time. But I agree with Harvey that the longer they keep rates higher and the more they raise, they're almost guaranteeing us a recession because at some point there's just not going to be much more investment. Corporations are going to they short up their balance sheets and consumers short up their balance sheets, but there's just going to be everything's going to grind to a halt going forward. Sure, the stuff in the past
what if
is
there's
fine.
like this collective awakening where people are like, oh shit, rates really are going to stay at 5%, and that changes.
And that's what it seems like
cost of capital dramatically in terms of investing in new projects. Jamie Dimon this morning, I didn't have a chance to read the article yet, but he said, I'm not sure if the world's prepared for 7%. I asked people in business, are you prepared for something like 7%? The worst case is 7% with stagflation. Now, again, I don't know why he's necessarily saying that.
Is it okay to go contra Jamie Dimon every time he makes one of these big pronouncements? As smart as he is and as great of a CEO as he's been, he was the one who said we were in a recession in 2022.
Yeah.
And prepare for a hurricane.
I think his track record.
7% rates. If we had 7% rates, the economy would be doing amazing in that scenario.
His actual track record speaks for itself, but his public comments about the economy forecasting have not aged well. And to be fair, whose has?
And so Mike Zaccardi posted this. Credit spreads, again, just don't care. So bond yields are rising. The yield curve is, what's it called? Disinverting?
Yeah.
Is it disinverting?
Steepening.
Okay. The yield curve is steepening, but not for the reason people would have assumed. Most people would have thought the yield curve was the longer end is going to stay where it is and short-term rates are going to fall. But instead, it's longer-term rates that are going up.
Is this a bull steepener? I think it's a bull steepener, but who can get this right?
No one predicted this. This is another thing that no one would have predicted. Like the reason the yield curve is the spread is going to decline is because long rates are rising. I continue to think that, boy, I wouldn't want to try to forecast anything over 6 to 12 months. But I mean, if you're a pension fund or an insurance company and you're seeing rates get up close to 5% for longer term bonds, I'm sorry. Over the short term, they could get hit a little bit. Over the long term, we're going to look back on this and think these bond yields were an amazing deal. I totally believe that.
Yeah, I agree with you. And we're not going to look back. It's already happening. So Balchunas tweeted, people keep piling into TLT, another $750 million this week. Amazing. Can't recall an ETF taking in so much money while being down so much and so consistent. So I think that investors are rightly taking advantage, locking in these high rates. And could there be some more downside in price? Yeah, of course. Who knows? But I think that investors are wisely piling into bonds here.
Average yield to maturity for the ag is now 5.4%.
Yeah, lock it up. Up.
I mean, I think all the things keep saying the highest rates since 2007 for most of them across the yield curve spectrum. I don't know. I think that's a pretty darn good deal, especially relative to what we've seen in the past.
Oh, it's great for investors, but it might be bad for the economy. Leading economic indicators,
which is good for investors, isn't it? Aren't we setting up for the threading the needle of this being a decent thing for investors in an economic slowdown? Is it possible?
Because you get high yields, and as soon as the economy starts to turn and asset prices start to soften, the Fed is going to ease, sending them back higher. I don't know. Maybe that's getting too cute with this kind of stuff, and that's wishful thinking. Leading economic indicators have been negative for 17 straight months, which I don't know if that is a record, but it's close. So
is it really that long? Jeez.
It's been a while. So yeah, I'm not saying anything. And then of course, student loans coming back online, which is not necessarily a drop in the bucket.
I want to put this take by you that I've heard recently, that the Galaxy Brain take, that higher rates are actually inflationary. Now look at this. This is a Wall Street Journal article about corporations borrowing. And remember we talked about how net interest payments, so net is net of what they're making on their cash, have been falling. And we're like, why are net interest payments still falling? And they use Microsoft as an example.
You know what? We had this chart on Animal Spirits Live, and I was like, I don't understand this from Sachin. I said, this is a great chart. I don't know what it means or how it's happening.
Yes.
I didn't factor in what you just said.
I didn't know that either.
So that makes sense. So carry on.
So they're showing Microsoft has more cash than debt. So Microsoft in T-bills now is making more interest income than they're paying on their low-rated debt. So by raising rates, the Fed has given them a raise on their cash since
So
they have more
wild.
cash than debt, which is, I'm sure, the case with a lot of these big companies, which, again, everyone keeps waiting for the Magnificent Seven to just fall and drop. And I do think it's also funny that every year we just add another company. It started off being Fang, and then it was like Fan Mag, and now it's Magnificent.
And Netflix is out. Nobody talks
Yeah,
about that.
that's true. Netflix got booted.
Netflix just quietly got removed. You know, this is what you just mentioned, Ben, is a great example of things that the textbook would say happen where you have to take into account other considerations. Like, okay, rates higher, interest payments up. Well, no, actually, not so fast. For all these companies that locked in low interest rates, right? Because they issued so much debt and have so much cash that there's actually a positive spread. There's nothing in the textbook that would suggest that would happen. And we're going to talk about this later in the show. Same thing with my view on U.S. residential real estate. You would think higher prices, higher interest rates, home prices down. Not so fast.
And this is the same thing for wealthy people who have all this money sitting in cash. Like they are getting a raise, and unfortunately, I think that's distorting a lot of things in the economy. I wanted to look at, you talked about how things have, like, everything looks bad right now, right? Rates are rising, the Fed is going higher for all the leading indicators, and the S&P 500 is still up 14% year to date. The NASDAQ 100 is up 35%. IFA, international stocks are up 8%. I don't know. Wouldn't you, if you were given all the headlines this year take away what we already know about the stock market. If you were given this at the beginning of the year and said, you're gonna be up 15% in the stock market this year with all this negativity, wouldn't you say, sign me up immediately?
Yeah, of course.
So it's just funny how obviously part of this is just the bounce back from last year, but it's interesting that the market is still not matching sentiment, which I guess is just something we're getting used to, that the market rarely matches sentiment these days.
I shared this chart with you yesterday. Since the Fed started raising rates, which I think is a blog post I'm going to do, since the Fed started raising rates, what's happened since. But since the Fed started raising rates, the median stock is not doing great, as you would probably expect, right? So I had Nick Majuli break down the median return by market cap decile since the Fed started raising rates in March 2022. And the median stock in the largest and second largest decile by market cap is slightly positive. But every other decile, the median stock is down.
The weirdest thing to me is that the smallest stocks are the third best performer out of the deciles.
Yeah, that is interesting. I ran this on my own, looking backwards, and I said, this can't be right. Because the median stock, if you look at today's Russell 1000 and you do this analysis, the median stock in the last bucket is down 41%. But that's almost like self-selecting because like Peloton's in there and it's all the stocks that got crushed.
No, they fell into that bucket.
Yeah, exactly. So I said, I had my
they didn't start
I had my Nick Majuli correct this for me. I said, hey, Nick, do this proper. And so this is what it looks like.
Yeah, that's a good chart. All right. Beating a dead horse here, but Spiva came out with their half-year report about index funds versus active funds. They look at all these categories across equities: small, mid, multi-cap, large, all the growth value.
We are beating a dead horse, but go ahead.
And if you look at the 10, 15, and 20-year numbers, it's not just average returns for indexes. It's top decile, basically across, and sometimes the top 5% you are being an index fund over 20 years, which again, dead horse, but is it actually becoming harder to outperform the market because of the informational advantage has been kind of taken away? I know, like, the whole argument has always been, listen, the market is active funds underperform because they are the market, less cost. That I get. But I think it's actually getting harder to outperform. And it's not like you can just say, well, it's because the biggest 10 stocks carry the day, because it's the same thing in mid caps. It's the same thing in small caps. It's growth, it's value, it's all this stuff. I just think outperforming the market now is actually harder than it's ever been.
I don't know if that's true or not, but it's probably mostly true. I guess in defensive active management, I would say for investors in active funds that believe that their manager is going to outperform, and even if they don't, and maybe I'm reaching here, if there was a behavioral edge to be had, like, and maybe this is probably backwards. I'm trying to say that like maybe you're more likely to stick with an active strategy if you really believe in the manager. But I think empirical evidence shows that actually to probably be the opposite, right? You're more likely to bail.
I think these numbers
Like
also
dollar weighted returns. Do investors in active funds do worse relative to the funds that they invest in than index fund investors? I would say that's probably actually
yes,
almost
they probably
definitely
do.
true.
I'm sure there's some Morningstar study on that, but I
I
think this.
tried. I tried.
But this is also probably why I think thematic funds are going to continue to see groundswell and see assets go into them, and why people are sticking with a fund like ARK because they believe in this innovation idea. And I think the thematic, that's like the new active, and it's going to take a while for that to filter through. But I think that's probably where most of the growth comes for active in the years ahead. All right, you had Jeremy Grantham on the Compound Friends, which was great because I still disagree with a lot of what he says and his view of the world, but uh, he's not a psychopath about it. He has good reasoning, and he's a smart, sharp guy. For how old is he again? Did you say 84?
84.
So I wanted to pull up. You wrote about this yesterday. I wanted to pull up his. You sent me this clip about him talking about a real estate bubble, and
Like
he
before you
said,
get there, I just want to just one thing. So I gotta say, interviewing Jeremy Grantham was definitely like one of the highlights of my career. Even though we've written with a critical eye about him and what he said, he's a gentleman, and I knew that he was before the show, and he's a legend. And
"Yeah, how could you
I
not
think,
respect the guy?"
yeah, I think the Perma Bear moniker um, is a little bit of recency bias, and I'm not saying that it hasn't been somewhat earned because he's been definitely cautious to outright bearish much of the last decade over certain times. But the guy's been around since 1969, and he has an incredible track record, and he's very, very thoughtful. He's not just a guy that wants to see the world burn. And we got a lot of comments like the one I'm about to read. I just finished listening to episode 110 of TCAF with Josh. Okay, Jeremy Grantham, man, it was so good. I always thought of Grantham as a perma bear, but listening to this episode completely changed my mind. Grantham's data-driven process, the way he thinks about investing, and the way he articulates his thoughts totally changed my perspective. And I couldn't agree more. Like if you, I get it. Believe me, I get it. But if you listen to him, he's probably not what you think he is.
No, he has an idea. He's built up this philosophy and this model of the way the world works, and unfortunately, the world hasn't really agreed to those models lately. And I feel it felt like you guys talking to him, where he was kind of going back and forth, thinking through like, do I still believe that these models work? And it was interesting to see the back and forth. So I wanted to bring up the housing bubble stuff because he talked about a global housing bubble, and he mentioned Toronto and China and Vancouver and all these places. And I actually I think it's really really hard to call a bubble while you're in it. I'm no good at that kind of stuff. But he mentioned like 2 or 3 times income and no one can afford a house. And I do agree that there are places like this around the world, but I don't think those conditions are being met in the United States. I think in places like Canada and Australia, in the United Kingdom, like if you look at, I did all these charts of since 1990, real housing price growth versus real disposable income. And we did this for Canada a couple weeks ago. So I just did
Yeah.
it for all these other countries too. The Japan one is crazy. Look at the Japan one. Same with South Korea. Because this starts in 1990, which is when the Japan bubble burst, and real housing prices are down by whatever 50%, and income has risen a little bit. That's because their bubble's so out of control. But the United States and Germany, I guess you could say, are the ones that look, actually reasonable in terms of income growth versus housing price growth. But places like Canada, Australia, France, UK, those ones are the ones where plus you not only do you have housing price growth that's way outpaced income, but you have the variable mortgages in a lot of these places. So the US doesn't have a lot of that stuff, right? People have done okay. People locked in rates. 38% of people own their homes outright and are not. So I think I would, if I'm picking bubbles, the US would be way down the line in terms of housing markets for seeing a huge price decline. And I would think it makes way more sense in places like Canada and Australia. And actually, at the end of the year, the last 9 months of the year, on a real basis, Canadian housing prices fell 20% last year.
Oh, they did?
Yeah, which is, I mean, a lot of that's inflation, obviously, but they are falling a little bit. And so I think if there is a housing bubble, it's internationally, it's not in the US.
Well, let me ask you this. If he is right and housing prices, because I think I said, like, what do you think is going to happen to housing prices? Like down 30%? I think he said that that's fair. Let's just assume that housing prices did fall by 20%, 30%. Would that lead to would that like take the economy to its knees?
I don't really think so because there's such a big margin of safety built up in home equity right now already. I think I looked at this before. If housing prices fell 20%, it would bring us back to like October 2021, if I recall.
And it's not
Wh-
as if there's now I know houses are a levered product, but it's not like people are levered to the hilt. See what I did there?
There you go. Nailed it.
Uh, with multiple houses and a debt to income that is even remotely resembling the pre-GFC days.
It was also, we went on a building binge in the 2000s and we didn't have that this time around. So I still think supply remaining constrained. I got to imagine if housing prices did start to fall, like the demand would pick up really quickly.
Yeah.
And
So,
if
all
housing
right,
prices were falling, you'd think rates were falling too. And I think that there's a floor under housing prices.
so
I
I
really do.
so I wrote a blog post yesterday, and I said that similar to the example that you gave with Microsoft and rising interest rates actually helping their net interest expense, I think that if interest rates were to even budge a little bit lower, you would see housing activity take off like a rocket ship. So Fortune wrote an article, House Poor is Back, where they said monthly mortgage payments are up 60% year over year, which is, obviously nuts. More than half of home buyers face a monthly mortgage payment of at least $2,000, while 1 in 4 are paying $3,000 or more. Meanwhile, average U.S. monthly earnings were just $4,600, according to economic data. That means that some homeowners could be spending more than 6% of their paychecks on a mortgage. All right, well, if it's two incomes, that's more like 30%, but still. Based on current mortgage rates, average income levels, and home prices, more first-time home buyers are using a minimal down payment. They could be paying more than 40% of their monthly income towards housing. Somebody was quoted, and this is what I was just alluding to, any relief in mortgage rates is likely to get absorbed by even higher home prices. So the housing market is absolutely broken.
It is.
But it's structural. Everyone is trapped in their house. Would-be movers are not moving because if you have a 3% mortgage, you're not moving. You're stuck. And then also, and I think this is probably like a minor, maybe not so minor thing. They said 40% of people under 30 were getting help from their parents. So there's 84 million millennials. I don't know how many are in a home, but a lot of them need to go into a home. And so could the great wealth transfer and that issue put a relatively high floor on their prices? I think it could.
Right. Hey, mom and dad, don't wait to give me this money until you pass away and it's an inheritance. Give it to me now so I can actually buy a home.
Right.
And afford it.
Right.
Which unfortunately makes a wider gap between the haves and the have-nots.
Yes.
But I think that's what's been happening in the housing market for a while. The funny thing is, too, we talked about the Fed raising rates so aggressively. I tweeted this last week and I showed rates going from everything 30 years and below at one point was under 1%. And now, everything is 5% or more, or approaching 5%. And I said, it's kind of crazy. Nothing is broken. And a lot of people came back and said, well, the housing market is broken. But
Totally.
I think nothing broke like people thought it would break. When people would assume mortgage rates going from 3 to 7.5, you would have assumed, okay, housing prices fall 20%.
Well, I think people thought that it would break and cause a panic.
Yeah, so that's the thing. Nothing has broken like anyone thought it would in terms of breaking, like the Fed raising so aggressively. Like sure, the economy is going to break, and consumers are screwed, and none of the stuff has broken like people thought. And obviously, a lot of people come in and say hasn't broken yet. Just wait,
But
it's coming.
true.
I know, but you cannot. But I still. This is my soft landing argument that it's been going on for long enough where I think we can say everything everyone thought was going to happen just didn't happen this time around.
And that, my friends, is what complacency looks like. From Redfin, a record 26% of home buyers are looking to move to a different part of the country, up from 24% a year ago and roughly 19% before the pandemic began.
Where'd you go?
Where did I go? Here I am.
Yeah. No, I mean on the
Good
docket.
to see you. Oh, we're in real estate. Sorry.
Oh, so we skipped ahead because I was talking real estate.
Yeah.
All right, I'm trying to keep up here.
Any thoughts on people moving, having to move? Midwest?
I mean, the thing is, people keep saying that like no one can afford to buy a house now, but there's still activity happening. It's just not very much.
I mean, a lot of people are completely frozen out.
Yeah.
So Michael McDonough, we've been talking about how the average mortgage payment is up 130% since pre-pandemic. So then he inverted it. So, all right, the average monthly mortgage payment assuming 20% down, current prices, is $2,300. So he flipped it. He said, how much home can you buy with a $2,300 monthly mortgage payment, assuming 20% down for a 30-year? And at the peak in 2020, or I guess when rates were at the bottom, it was you could buy a $700,000 house. Now with that same monthly mortgage, $400,000. I mean, the housing market is completely upside down.
And what do you think people are going to do? Do you think they're going to change their expectations and go to a much lower end house, or just
No.
eat it and pay 50% of their income for housing? They're going to eat it.
They're going to eat it.
Right?
Yeah.
Which, yeah, eventually.
Now, I mean, surely that should lead to less disposable income, right? And the consumer drives the economy. So isn't this one way in which housing can slow down the economy?
Yeah, unless we all just take on a bunch of credit card debt.
Now, the other thing is like what I just mentioned. Yeah, point taken. The other thing is how many people are buying new homes relative to the whole population.
Yeah, it's a very small percentage.
It's very small. Ben, you just mentioned credit cards. We haven't done a survey in a while. I know I'm jumping around the dock. A third of Americans earning $150,000 a year or more say they're living paycheck to paycheck, and many rely on credit cards to close the gap per money-wise. Now, I think, and I don't know exactly how the question was.
Paycheck to paycheck.
I don't know how the question was worded, but Ben just did air quotes around that. Yeah, because once, they're saving, they're contributing to their 401k, and then once you save and spend, you're out of money, right?
Yeah, listen,
so I think
after my 401k and after the 529 and after private school for the kids and after the Taylor Swift concert,
I'm broke.
I'm living paycheck to paycheck.
Right. So I also think like the rely on credit cards could be doing a lot of work in that survey. Now the headline is, oh my God, a third of Americans earning 150 grand live paycheck to paycheck. But the reality is people might just, I rely on a credit card. Well, I think most people do. Now, if credit cards didn't exist, I wouldn't rely on it, but they do.
Yes. I heard a good, probably a old wives' tale, but that the chargers are called that because of credit cards. Did you hear this?
They're trash.
Fair. All right, let's go back to investor behavior.
Okay. This is interesting. I was about to apologize to Chargers fans, but I realized that there are none. Zing. All right. Since the early 2000s, there's been a structural decline in bullish sentiment. This is interesting.
So if you did like a moving average of this, it is funny.
You know what? Are people just not allowing themselves to get fully? These are boomers, and they've seen some shit in the market, and we've said, oh, you've written a lot. Oh, the boomers have had it so great, falling interest rates, rising stock prices. I mean, they also had two monster crashes.
Yes, I can see. I the first decade of this century, I think, really screwed a lot of people.
Like I think like investors had it great or boomers had it great. There's a lot of hindsight working there because I don't think it felt too great as they're entering like their money making years, and they see a monster crash, and then all the shit that transpired after, and then as they're starting to get back to even, oh great, we're at new highs finally. It's been 7 years and the market has finally recovered. Oh yeah, eat this 60% decline.
Yeah, that's true.
So I think it's like, you're not going to fool me a third time. I think investors aren't allowing themselves to get like euphoric. Now I know 21 was a different story, but
this is also another example of watch what they say, watch what they do, not what they say, because a lot of those boomers have increased their allocation to equities over time.
Totally.
So they're saying they're bearish, but they're investing like they're bullish.
Yeah, that's a good point. All right, this is interesting. There was an article in the Wall Street Journal. Title was, you might be paying too much for that index fund. Okay. State Street last month slashed the fee on its cheapest S&P 500 ETF. The ticker is not SPY, it's SPLG, to 0.02%, making it less than a quarter of the cost of its popular SPY fund that tracks the same stocks. All right, $1,000 investment in SPLG, and that's just US, that's the S&P 500, is 20 cents a year on $1,000.
Jeez.
So look at this next chart. We're looking at total assets under management. SPY has ballooned to 400 billion. SPLG is coming up the rear. It's at 19 billion, basically up from zero in 2017 maybe. If you look at the change, like the total assets under management as a percentage over the last, since pre-pandemic, I think this was, SPLG is up 200%. SPY is up 42%. Now, again, this is not apples to apples because one is coming off a gigantic base. And I guess there's two things here. One is just marketing is very powerful.
SPY has the brand.
Brand, I should say, not marketing. SPY is the brand. But also it's got the assets. And I'm sure a lot of the money that's going in here is being used by gigantic institutions for either hedging or short-term trading, and they don't necessarily care about the expense ratio.
Yeah, that is.
But what a win for investors. What a win for investors.
I've honestly never heard of, I guess, SPLG, but it makes sense that they have. It is kind of funny, though, they didn't just decide to make SPY have that same expense ratio. Like the SPLG.
They don't have to. There's no reason for them to slash it.
I know, but which is funny. Like they have SPLG to cover themselves, but you'd think that why not just make SPY 2 basis points?
Well, why would they?
Someone sent me this. We talked last week about what is easier to lose in, gambling or trading options, day trading. And someone sent me this infographic here: casino gambling versus day trading. 13 out of 100 gamblers leave the casino a winner. 1 out of 100 day traders reliably beat the market. I don't know. I've never really thought about what the winning percentage is for a casino, but that's way lower than I thought. I would have assumed 30%, maybe 20%.
I think I would have too. I would guess my winning in a casino, I don't know. I'd probably lose 3 times for every time I win.
I'm a winner. I'm like 55 to 60% winning on blackjack.
That's not possible.
No one ever believes me. It's true. I've had some amazing blackjack streaks in my life.
I don't even think that's true because I really only play blackjack. If I play craps, I lose every single time. That's just what you do. At least that's what I do. But blackjack, the odds are not that high in the house's favor. So yeah, maybe I win 4 to 10 times.
Maybe I wouldn't anymore because they changed them. They don't pay as much on the blackjack, but yeah.
Nobody cares, but I am. We spoke about God, I love betting on sports. What a rush. But what a kick to the pants. I had the Ravens as the 4th leg in a relatively big parlay, not to brag. And man, that was a brutal loss. Just brutal.
But this is why people continue to gamble, because
it's so much fun. The action is the juice.
Yes. And you could put $10,000 on a stock and not get the same emotional boost that you get from betting $100 on a blackjack hand or something.
Well, yeah, because it doesn't go to 0 or double.
Wow.
In 30 seconds.
True. But obviously this is why gambling will always have a place, because those feelings you can't recreate those.
You can't replicate it. All right. This is a good chart. People are rightfully annoyed about rising gas prices, and this chart doesn't really do anything to calm people's emotions, but it just happens to be a fact. As a share of income, the price of a gallon of gas is barely half of its 2008 levels.
I tweeted this the other day that if you go to the highs in 2008, retail gas prices are down 38%.
But also, why should we
basis?
But why should we anchor to that is ultimately cherry picking.
Yes, and I did say I cherry picked this data. I admitted it, but
yeah.
But it is true that gas prices haven't kept up with inflation for well over a decade, which is kind of hard to believe.
Yeah.
But yes, cherry pick. All right. This, I've never heard of this. The DOP Gamble. Maybe this is a website you've heard of. Had this thing on NFTs that kind of went viral. Of the 73,000 and change NFT collections that we identified, an eye-watering 69,795 of them have a market cap of 0 ETH, meaning they're worthless. So 95% of people holding NFT collections are currently holding on to worthless investments. Even if we look at the top NFTs, the value is hard to find. Startling 18% of the top collections have a floor price of 0, indicating that a significant portion of even the most prominent collections are struggling to maintain demand. Furthermore, 41% of the top NFTs are priced between $5 and $100. Wasn't this the easiest one to call out of anything? Just that, you know who walked away? I mean, I'm sure people made a lot of money on this and sold. Remember the Beeple guy? Didn't he sell his collection for like $70 million? I'm sure that's completely worthless.
That was one painting. Or image or whatever.
So 1% of them boast a price tag of over $6,000. I mean, this was the easy one to think of. Just the jokes of, hey, I just right-clicked your picture and I stole it. And
I think that even people that were Super Bowls on NFTs, a lot of them were saying this at the time, that 99% of these collections are going to 0. I think that was like consensus even among NFT bulls.
The one I really remember the most is these Ether rocks. And I remember Drew Dixon tweeted this, and he just re-upped it, so I found it. And he said, there's this Ether rock, which is literally a picture of a rock that looks like you could have drawn on Microsoft Paint, was selling for $2.2 million. And he said, what would you rather have, this picture of a rock or a $2.2 million house in Florida on the water with a sweet boat launch and a pool? And obviously this was just funny money at the time. But that's the one that always stuck with me to like how crazy it was. Like, wait a minute, honestly, why would you rather hold this stupid thing in your wallet unless you're laundering money for tax purposes or something? Also, so Zillow has this house, so I looked at it. So this was in 2021, and it was selling for almost 2.3 million dollars. Okay, so you can look up the price history. In March of 2022, this thing sold for 2.1 million dollars, and then in January 2023, it sold for 2.3 million dollars, and then by February, it sold for $2 million. Housing prices don't always go up.
Why is there so much turnover in this house?
I don't know. Oh, maybe the pending sale fell through, but it sold for less money than it was trading for at the time.
Should have bought the pet rock or the ETH rock. I think my take on NFTs at the time, I do think there's something interesting about digital ownership. Like one of the examples that I threw out was like every time I go to a Knick game, like I don't have my tickets. I used to have like tickets in a box. I don't know where they went. To be able to look back and have some sort of digital ownership, digital entrance, like I think that part of it is
but
interesting.
doesn't mean it had to be worth something. And also,
no.
I like the idea of using it as a key to unlock, like
what we did with our Discord.
Yeah, the community, like you use the NFT as the key to unlock it, but that doesn't mean the NFT has to go up in price all the time and be worth 20 times what it was.
So my take at the time where these things were going nuts is like, how do you explain this? And I guess I was trying to justify the insanity. Was these were people, for the most part, these were people that were ETH millionaires, and it was all funny money. It was poker chips. It was credit card points, whatever you want to talk, however you want to label it. For the most part, it wasn't people depositing $200,000 of cash,
right,
and buying these things. It was people
it was monopoly money.
It was monopoly money.
But I'm just saying, how many of those people do you think are kicking themselves for not cashing some of that out and buying a $5 million house on the water?
Now, being a cynic, and I guess a realistic cynic, is a lot of those people did cash out to people that were actually using real money.
Yeah, true.
Which is a shame.
All right, so I created an AI image. Do a blog post and you have to have some little thumbnail for the social media. So I always put a picture.
You created one, or you created one?
So look at under AI here. So I wrote a post the other day about 24 things I believe about investing, and you need a little picture there for the blog and then for social media. And I didn't usually, if I have a chart, I just include the chart in there. But it didn't have anything. I told a little story about Jeff Bezos and Warren Buffett, and so I said, you know what? I couldn't find a picture of them together. I'm going to create one in AI. So went in AI, and I had to type a bunch of different things in, and I wrote like Jeff Bezos, Warren Buffett, investing. And this is
what website did you go to?
Whatever free AI, there were a bunch of them came up. It's just like AI art generator, whatever. And this is the picture that came up. It looks pretty good, but it also looks kind of weird, doesn't it? Like there's something just like 3% off about
Bezos is dead on. Buffett looks a little off.
Yeah, but I tried like 10 different iterations, and I'm like, that's actually kind of. So I've been playing around with it a little bit. Some of the stuff it couldn't do yet, but for something like this, I thought it was kind of cool.
Yeah, it's great. Ben, last week we spoke about NAV lending. The FT did a follow-up piece. Goldman Sachs has raised more than $15 billion to buy investor stakes in private equity funds and invest in deals where buyout groups sell portfolio companies from one of their funds to another. And the latest sign of sustained support for the fast-growing, quote, secondary strategy. The opportunity set is as big as it's ever been. I don't know who they're quoting here, but the need for some investors to get liquidity in an asset class that typically locks money up for more than a decade has offered attractive investment opportunities.
Money on top of money, huh?
Yeah. Now, I guess I could see that from the point of view of new investors that are taking out old investors that want liquidity. But doesn't this just turn the concept of the illiquidity premium on its head? If you're bringing gallons of water to these markets, then what are we even doing here? If the whole idea is like you're locked up and therefore you're going to earn a premium for giving up liquidity, then
it used to be this. When I was back in my private equity days, it was the secondary markets. You'd buy them at like 50% discounts, like to offload that penalty for liquidity was a huge discount.
Yeah, I bet you the discounts are not 50%.
I'm sure they've fallen a lot, but that's what it was back in the day, which is kind of, and that's when you'd buy like a whole fund. But that's kind of hard to believe that, yeah, you wouldn't have to take something. Okay, here's a good one. Gen X today is significantly wealthier than boomers were at the same age. We talk about boomers having it easy. this is adjusted for inflation, 600,000 for Gen X and 500,000 for boomers at the time. I think the median age is around age 50 when this happened. So, and millennials today are about equal in wealth to boomers at the same age, just over 100K, all inflation adjusted. Some people said, well, a lot of the inflation rate you use kind of has a lot to do with this, but I don't think many people would assume Gen X has had it easier than baby boomers. Although, I mean, no one ever talks about Gen X and their experience and what happened to them.
I'm sorry, these comparisons are just dumb.
Why?
I don't know. Like, okay, so Gen X had it easier, they didn't. Millennials had it hard. I mean, who cares?
Class warfare.
I know. I don't like these things. It's just a way to divide us. I'm all about bringing people together.
I guess my point with all of this is it's hard to judge a whole group like this and the individual circumstances and luck and timing. All of it it's like anyone's personal finance experience is going to be dictated more by luck and timing than most people would love to.
Yeah, the reason why I don't like these sort of comparisons, even though like I understand what we're doing here, it just creates a system of like winners and losers and people that feel bad and anger and nothing.
But that is going to happen on steroids with the housing market going forward. In the future, people are going to look back at 2020 and go, "You bought a house before 2020. I hate your guts.
Yep.
I didn't get one.
Yep.
I got screwed." There's going to be so much more of that now. I feel like with the housing market, it's going to get worse and worse and worse, unfortunately. All right, here's another. We've talked about this before. Sonu Varghese wrote this from Carson Group, and it shows bottom 50%, 50th to 90%, 90th to 99, and top 1% by wealth. And he shows the growth in wealth from 1992 to 2006, then 2007 to 2019. And those ones go in order. The lowest people on the rung grew the slowest. The people in the top 1% grew the fastest, except for 2020 to the first quarter of 2023. By far, the largest relative increase in wealth comes from the bottom 50%. And they more than doubled up the increase as the top 1%, the top 10%, all of this stuff.
Love to see it.
But is this another reason why the consumers remained so much stronger? Is that even like the bottom 50% saw their net worth just skyrocket like they haven't seen in decades? Right? How many people actually would know this fact? If you just talk to people on the street, did Family Feud style survey, 3 people out of 100 maybe would say the bottom 50% has seen the biggest increase. Maybe.
What do you think? What do you think is more important for sustained growth for the economy? Or said differently, what would be worse for the economy if the top 1% came under financial pressure or the bottom 50%?
Which is better or which is worse?
Which would be worse for the economy? I think the bottom 50%.
Bottom 50, because
they're spending everything.
Spend a higher percentage of their income.
Yeah, so if the top 1/2 of 1% is feeling the pinch, all right, they're not buying paintings.
Yes, they have a much bigger margin of safety too from financial assets. And
so is this an underreported or underexplained aspect of why the economy remains strong? Is the bottom 50% is doing relatively okay?
Yeah, didn't I just say that like 2 minutes ago?
Yeah, I'm agreeing with you.
Thank you. It's a good call, coach.
Coming around.
You really do look like a JV football coach. I think that's your call.
I'm feeling pretty good about this is my Belichick outfit. I'm feeling pretty good about my preseason bet of Patriots under 7.5 wins.
Okay.
Not feeling great about my Giants over 7.5 wins.
How many bets do you have going on at one time? Because it sure seems like a lot.
You know what FanDuel needs? You're right, Ben. I do have a bunch of bets going on at one time. The FanDuel needs to have, so when you're looking at your phone and you see active bets, I don't want to see my futures bets. I don't want to have to scroll through my futures bets. I want them in a separate column.
Okay. Those are the only bets I make anymore. I bet like 4 teams to win the Super Bowl, the NBA Finals every year, and that's it.
It's unbelievable. We're so different. You're a set it and forget it sort of investor.
It's true. Yes, it is true. And you're doing
I'm intrigued.
8-team parlays, and I had a bad run. I had a really bad run in the NFL season a year or two ago, and it soured me to the whole deal.
Hello.
I kept getting screwed.
Hope? What about delusion? Hope doesn't spring eternal?
I was getting screwed on all of these picks, and I'm just like, you know what? I'm done. I'm not doing this anymore. I've had enough, and kind of went away from it.
All right, Derek Thompson tweeted, it's mostly cringe for middle-aged people to gawk at general changes in younger generations, but the anti-socialization of childhood in America is really a stunning thing to see all at once. So from 1976 through 2015 or so, we're looking at the number of people that have a driver's license, that have tried alcohol, that have ever dated, that work for pay. And these things, you might say this is social media. These things have all been in a downtrend since basically the mid 90s, I guess.
90s, probably.
Now it's accelerated and crashed. Ever dated, for example, is alarming. It's an alarming crash. There's another chart that shows the percentage of 8th, 10th, and 12th graders who spent an hour or more leisure time alone nearly every day. And that is going the opposite direction, as you might imagine. That's skyrocketing.
That's screens. That's
matters.
screens, though. Yeah, and I think there's nothing we could do about it. Honestly, with screens and social media, I think this is the new normal.
I saw,
and everyone is going to get married in the future from dating apps. Isn't that just where we're heading?
Yeah, I saw. I was watching something on Instagram. It was nostalgia overload. It almost made me cry. I don't know why. I got emotional watching it. It was the introductory songs from shows from the 80s. Full House, Family Matters, Who's
you know
the
what
Boss?
The best one ever is, right?
Growing Pains, Wonder
Growing
Years.
Pains. Growing Pains is the best one ever.
Growing Pains is terrific. How weird was Charles in Charge? Was Scott Baio basically an au pair?
That was kind of a bizarre. I mean, people just didn't. So,
and Who's the Boss? How weird was that show? If you think about it,
the 1980s is such a weird time for pop. So I was thinking about this. One of my favorite, all-time favorite Tom Hanks movie. If you asked me under Truth Serum, I'd say Money Pit, even though it probably should be big.
Yeah, I've never
Tom
seen
Hanks,
it.
he has his 1980s, so it's on Netflix, and I looked at it.
Oh, it's on Netflix?
Tom Hanks, one of our greatest actors ever. And right when you start the movie, I've never noticed this before. It says, Steven Spielberg presents The Money Pit. So Steven Spielberg executive produced, Tom Hanks starred, and it's a slapstick comedy about a husband and a wife who are building a home together. And it's totally 80s. It just cracked me up that one of the greatest directors of all time, maybe the greatest, and one of the greatest actors of all time in the 80s collaborated on a slapstick comedy that would be like a straight to DVD movie today.
I got to see that.
It's totally.
But anyway,
80s.
just watching these songs, these intro songs from the 80s, like thinking about how different life is. And I'm not saying life was better necessarily in the 80s, but some things were better. Now I'm a 90s baby. I was born in 85, but
okay. No,
although I do remember growing up with a lot of boredom, I must say. Like there was definitely just some sitting around looking out the window type stuff. Just like, oh, should I call? I guess I'm just going to call this person's house and see what they're doing.
This is also why I've seen every movie from the 80s or 90s like 12 times, because USA, TNT, TBS, the summers, that was my babysitter. I just watched movies all the time.
All right. I saw this the other night and I thought I was taking crazy pills. What was I watching? I was flipping through. I think I was on ESPN. I've said before, I'm not a flipper, but I happen to be flipping. I came across Cornhole.
Oh, yeah. I've seen that before.
And it said it was on ESPN 8 the Ocho. Wasn't that from Dodgeball? Wasn't that a joke?
Yes, I think.
Did they turn this into a real thing?
I think they made it kind of a joke and turned ESPN 2 into ESPN 8 to be
like wink, wink.
Yes.
Okay. Ben, I was in the supermarket yesterday with Logan, and my wife told me to pick up a piece of salmon for her. So I waited on the line, you know, where you get the tickets. And I was thinking, how fresh is this food? There's 4,000 pounds of prepared foods here. You know what I mean? Meatballs, chicken parm, this salad, that salad, whatever it is. How often does that turn over? And how would you even know if it's fresh or not? There's no way they do it every single day. There's just no way.
They've got to have some sort of. I often think about that at the supermarket and liquor stores. Like with as much inventory as they're carrying, how do they ever make money?
Yeah.
In the
Don't forget
margins
about the
being
money making
so thin?
aspect of it. How do you know? How do you know how old your food is that you're buying?
Roll the dice. You're a gambler. You're rolling the dice. You play craps every time you buy salmon at the store. It's like a parlay.
Are you a prepared food guy?
We have a pretty good meat department at my local place. Yeah, it's not bad.
That's not what I asked. Meat is not prepared food. You cook meat. I'm saying, like, do you go to stores and get meals that are already made?
Oh, occasionally, like the Costco tacos are pretty good. They have like a kit, you know, that kind of thing. The chicken Alfredo my kids like from there.
You're not understanding. There's not a. I'm not talking about kits. I'm talking about you see the food that's already made. You go and buy it, and then you heat it up.
Isn't that what this is? What I feel like we're talking about the same thing.
No, you're talking about a taco kit.
Give me an
saying
example.
I just did a piece of salmon, teriyaki salmon. That's what I bought for my wife.
Yeah, I'm saying at the meat department, it'll be like chicken. It'll be like a chicken kebab ready for you to go, and you just got to cook it. Yeah.
No, I'm saying not even. Now, what you're describing, yeah, if you go to a butcher, they'll have.
So you're saying the salmon's already cooked?
Yes. All you have to do is heat it up. All you have to do is microwave it. That's what I'm saying.
Okay,
Prepared foods, not raw, prepared.
Okay, that sounds kind of gross.
I'm saying.
Okay, yeah, then no, I wouldn't do that, probably.
Okay. And not to judge my fellow Americans, but the people online, a little on the heavy side.
It's easier to eat bad than it is to eat good.
That's a fact. All right, recommendations. All right, I think I nailed this. Not to brag. Apparently, this is from Barstool. Apparently, Aquaman and the Lost Kingdom is so bad that audience members walked out of test screenings. I said last week that was the absolute worst trailer I've ever seen in my life. Now, I am a trailer guy. Whenever I see people say that trailer looks awful, I usually don't understand because I like all trailers for the most part.
It's usually a bad sign, though, if the trailer looks bad or if it's a comedy and doesn't make you laugh. That's a bad sign.
Yeah. So if the trailer looks bad, you know it's bad.
Yeah.
I was talking with my trainer the other day, as I do. Now, my trainer, I hate working out. God, do I hate it. And I know that if I'm not paying this guy to watch me work out and say, yep, you're doing great. Like,
it sounds really creepy when you put it that way.
I was thinking of Chubb and Happy Gilmore.
Okay.
When he's giving the lessons to the lady and he's just
reading.
Anyway, I really do hate working out. But so we schmooze about movies and whatnot. And
see, this is where we're different. You get the emotional high from gambling and hate working out. I get the whatever it's called, the endorphins, or whatever you get from working out. I get that, and like I need, my body needs that at a certain point. Like I feel better after I work out. Like I enjoy working out.
Yeah, I hate every minute of it. We were talking about The Recruit. I don't know how that came up, but we were both like, "Oh, what a great movie! Great movie!
I love that movie. I've seen that movie 10 times.
Great movie. I saw it in the theaters. Factually, not Field of Dreams, but I know I saw this in Florida with my dad. As a matter of fact, it got a 43% from the critics and a 58% from the audience. What the hell is going on? If you haven't, I mean, those are horrible numbers. If you haven't seen The Recruit, put that right at the top of your list. If
that movie was released this year, it would be like a top 10 movie of the year.
Totally. Colin Farrell goes to the farm? Is that what they call
CIA,
it?
Yeah.
And Al Pacino is the trainer, for lack of a better word.
Tom Brady's ex, Bridget Moynihan, is in it. It's a good movie.
Hell of a movie. All right, this blew my face off. With $633 million domestically, Barbie has now outgrossed, this is from Eric Davis, Barbie has now outgrossed the first two Avengers films and every Star Wars film except for The Force Awakens.
Wow.
Greta Gerwig's film has also outgrossed every single DC film to date. Watch The Flash, that sucked. I didn't like it. Isn't that crazy? Barbie beat the first two Avengers and every Star Wars film?
It's another brand kind of thing.
I'm going to watch it. Are you going to watch it? I haven't watched it yet.
No, I'll see it eventually. I didn't really care to go see it in the theater, but I'll watch it eventually.
All right. So I watched this movie literally called #Chad Gets the Axe. Now,
where do you find this stuff?
I'll tell you exactly where I find this stuff. I scroll on Prime for new rentals, and I judged a book by its cover. And I went to Rotten Tomatoes. Got 100% from the critics. Now, only 8 reviews, but still. And a 75% from the audience. And then I read the description. 4 social media influencers live stream their trip to Devil's Manor, the former home of a satanic cult. But things start to go wrong. As the violence increases, so do the views.
Wow. Okay.
And I gotta say, am I recommending this? Not necessarily. But if this sounds good to you, it was good. It was actually good. It was scary.
If this sounds good to you, punch yourself in the face, please.
It was scary. It was scary. It was effective.
I don't know how, after seeing hundreds of these movies, you still get scared.
Not only do I get scared, but I'll tell you this. I'm embarrassed to admit this, but I get scared. I guess that's the point. Sometimes I'll mute it because I get too scared.
I don't know. I watch these movies and I'm like, oh, okay, I see what's happening here. That's interesting. And it doesn't do anything for me. All right. So they had a Bronx Tale on Rewatchables last week. So I rewatched that, and then it got me thinking that I started Wise Guy by Nicholas Pileggi.
Wait, I want to hear your take on Bronx Tale.
Oh, I hadn't seen it in 20 years probably. I thought it aged great.
it's like a Netflix movie in the sense that like it's good, but in a better director's hands. Like De Niro directed it. It could have been great, and it wasn't, but it was definitely good.
Yeah, it's a tier below like Casino and Goodfellas and all those, but I still like it. So it reminded me that I started Wise Guy, which was the book that Goodfellas is based on. I thought I got to pick that. I read like 10% of it on my Kindle and I just forgot about it. So I started reading it again, and it's just crazy to me. So the stuff. Remember in the movie where they hijack the Air France flight or whatever? Yeah, but they made it sound like these guys would go to Newark Airport, and that was like this was their income. They hijacked like 2 to 3 shipments a day. And they owned the union guys, so they couldn't get the truckers fired. And like that's how these guys lived. They would
Security?
just steal. They would just steal. Yeah, they would just steal stuff all the time, and it was like that was their job basically, just to steal stuff. And they talked about how the Jimmy character, who De Niro plays in the movie, they said he had a really bad background. He was foster homes and sexually abused, and you can kind of almost understand how this guy became a serial murderer. But they said he loved stealing so much. He said you could offer him $1 billion to stop stealing. He would say no, but then he'd figure out a way to steal the $1 billion from you. That's how much he loves stealing. Anyway, it's the book makes me feel like the author of the book does not get enough credit for how good the movie is, because he told 2 parenting things. I watched Welcome to Wrexham, came back again. I think I've watched the first 3 episodes. It's just as good as the first season.
I don't know. Could you bring me back up to speed? I don't know what that is.
It's the one where Ryan Reynolds and Rob McElhenney buy a team,
you're a
soccer team.
Forgot about that. Yeah.
Yeah, it's so good. And it's not even just those 2 guys. Like the whole second episode is a parenting one about children with disabilities. And it was just so well done and like kind of heavy. It was.
But wait, it's not a show. It's based in reality, right?
It's a reality show. And they also, they highlight the fans of the show, of the team and the people in the town. And it's just really, really well done. And then Matthew McConaughey was on Smartless last week, and they did a really long thing about parenting and being a father. And I thought like they're all kind of just sharing how they think about parenting. And I love kind of hearing about that stuff. And their kids are a little older than mine. I thought it was really well done. Good one.
As good as hashtag Chad gets the axe?
Not quite. Maybe McConaughey would have been in that before he got Dazed and Confused. I feel like your movie recommendations are just like
That's not a recommendation. I'm just telling you what I watched.
I know, but the stuff that you're watching is just it's there's so many horror movies these days. I feel like you've hit them all, and they're getting worse and worse.
Dude, Talk to Me was excellent. Okay. Excellent.
The worst part about it is I know there's people who listen to our show who are on board with you with these movies. You guys are all
I'm not
sickos.
The only one.
You're all sickos.
So here's the top box office movies this weekend: The Nun 2, Expendables 4, A Haunting in Venice, The Equalizer 3, Barbie, My Big Fat Greek Wedding 3, It Lives Inside, Dumb Money, Blue Beetle. I mean, this is not a great slate of movies.
All right. animalspiritspod@gmail.com. See you next time. Chad gets the axe.